Fannie Mae just removed their 620 credit score requirements, and people are freaking out. Does that mean that you can now go buy a house with a 600 credit score, 580 credit score, 560, or maybe even lower? Let's break down what this really means for you in the simplest way possible. Before we get into what it really means, you've got to first understand what Fannie Mae is. Fannie Mae is a government-sponsored enterprise that provides liquidity and stability to the U.S. housing market by purchasing mortgages from lenders and selling it off to investors as mortgage-backed securities. And this is guaranteed money backed by the government. By doing this, what this allows to be done is it frees up money for the lenders to make new loans and ensure the availability of affordable mortgages across the country. So what's changed? Fannie Mae, the most common conventional loans for years had a minimum hard credit score of 620. So meaning if you didn't have a 620 or above, it didn't matter how good your income was, it didn't matter how much money you had, it didn't matter if you were putting 20% down. If you were below a 620, you couldn't get approved, period. But now that rule is gone. So Fannie Mae literally removed that 620 floor, and this is huge because it doesn't mean that everyone under 620 is automatically getting approved now, but it gives people that were under 620 more opportunities to be able to get a great conventional loan through Fannie Mae. So most people are wondering, so does that mean that you can buy a house with a 580 credit score now? Technically, you could have the entire time through non-QM loans, but with Fannie Mae now, you are able to get into the qualifications, get even past through the desktop underwriting to be able to go through a manual underwriter if your file is very difficult and you want to be able to get a great conventional loan. So credit score is just one part of the automated underwriting system that Fannie Mae uses, the DU, but they're still going to be looking at your debt to income ratio, your payment history, your late payments, your savings, your reserves, how stable your income is, and as well your down payment. And if the rest of the profile is looking good, then DU might approve you even if your score begins with a 5. But if you've got a high credit card balance, recent late payments, high debt, no savings, then DU is probably going to say no. So yes, the door is now more open to everybody, but it's not wide open. Why did Fannie Mae do this exactly? I think that really the housing affordability is a big issue that the president and as well everybody in the government is trying to solve right now. And I think that the housing affordability is the biggest factor on why they probably made this change, because now they need to be able to expand access somehow, and removing that floor allow them to be able to open this door for other people as well. And because the reality is people with lower scores were locked out even if they were fully capable of paying that mortgage. And Fannie Mae basically said, hey, instead of the 620 cutoff, let our algorithm decide who deserves approval. And I think this is a great way to go about it. All right, so here's the part that nobody is talking about, and this is where people get confused. The first thing is not all lenders will follow this immediately. Just because Fannie Mae changed the rule doesn't mean that your lender's internal guidelines have changed yet, and some lenders may still require a 620 minimum until they update their system to be able to meet the Fannie Mae new requirements. Second thing is the lower score still means that you're going to have a higher interest rate. Even if desktop underwriting gets approved at 580, 600, your rate is probably going to be significantly higher. You at least get the loan. The cost might be a little more, but I do think it's worth it in most cases, even with non-QM loans. And 3, you might still need a bigger down payment or more reserves. Just because desktop underwriting has approved you at the lowest score, they may just make a contingent upon you having a certain amount of cash for them to feel safe. And 4th, the mortgage insurance will be higher. If you put it 3 to 5% down, have a low score, PMI could be potentially more expensive. So just remember, approval does not equal affordable, right? Just because you're approved up to $800,000 for a mortgage does not mean that you should go take out an $800,000 mortgage. Your loan officer is not gonna, or your mortgage broker are not gonna know about your finances as much as you do. So that's something that you always want to keep in mind, is making sure you still keep it affordable. So if you're approved up to $800,000, maybe your budget realistically still should be in the $300,000, $400,000. And that's something that only you would know if you really stay in tune with your personal finances. But this will at least allow you to be able to get more opportunities. Who actually benefits from this? A lot of people benefit from this. You will benefit the most if you're close to 620, but not quite there yet. And if you have a stable income, you have cash reserves, you've had time to build a solid payment history, but you just happen to have that lower credit score than 620. You have low balances, but your scores just have not caught up yet. You had a medical collection or old issues holding your scores down. Basically, people who are trustworthy borrowers, but does not have the 620 and up, that doesn't look cute on paper, right? So this change helps a ton of first-time home buyers, millennials just trying to get into the market, investors with strong income but a temporary lower score, people coming out of past financial setbacks. So my advice as someone with multiple rentals, I think this is an amazing opportunity for everybody, primary residence purchasers, and as well investors. If your score is under the 620, but now you qualify, don't just automatically run and buy immediately. You got to start running through your numbers and seeing, is this payment affordable, right? As I just mentioned before, your rate is going to be typically a little higher, but all that matters, especially if you're an investor, does the deal still cash flow? Will the PMI destroy your returns? Would waiting 2-3 months to improve your score save you tens of thousands? Right? Remember, a lower credit score doesn't only affect approval, it affects your entire loan cost. So these are some things to consider before you jump right into it. Here's what you should do next if you've been thinking about purchasing, but you weren't hitting that 620 minimum just yet. First, reach out to your lender or mortgage broker. If you need one, I've got a phenomenal mortgage broker that I can connect you with. The benefit of using mortgage brokers is they can shop around at hundreds of different lenders and be able to get you the best rate and terms. So second thing that I would do after you connect with them is ask if they've updated their guidelines yet. And then third thing that I would do is, while you work on getting qualified, still work on improving your credit anyways, because even a 20-30 points difference can save you tens of thousands of dollars on a mortgage. So just constantly work on that. I hope you found this information valuable. If you did, please hit that thumbs up button and as well consider subscribing. Comment down below, let me know what your thoughts are on all these changes.